Assalamu alaikum dears, and greetings to all of you. Welcome dears to this video. I would be delighted to introduce an informative and quick session in this channel, which focuses on Islamic finance insights. Please support us by subscribing and following upcoming videos. So, let's start our session. Murabaha. Most of the Islamic banks and financial institutions are using Murabaha as an Islamic mode of financing, and most of their financing operations are based on Murabaha. That is why this term has been taken in the economic circles today as a method of banking operations, while the original concept of Murabaha is different from this assumption. Murabaha is, in fact, a term of Islamic fiqh, and it refers to a particular kind of sale having nothing to do with financing in its original sense. If a seller agrees with his purchaser to provide him a specific commodity on a certain profit added to his cost, it is called a Murabaha transaction. The basic ingredient of Murabaha is that the seller discloses the actual cost he has incurred in acquiring the commodity, and then adds some profit thereon. This profit may be in lump sum or may be based on a percentage. The payment in the case of Murabaha may be at spot, and may be on a subsequent date agreed upon by the parties. Therefore, Murabaha does not necessarily imply the concept of deferred payment, as generally believed by some people who are not acquainted with the Islamic jurisprudence and who have heard about Murabaha only in relation with the banking transactions. Murabaha, in its original Islamic connotation, is simply a sale. The only feature distinguishing it from other kinds of sale is that the seller in Murabaha expressly tells the purchaser how much cost he has incurred and how much profit he is going to charge in addition to the cost. If a person sells a commodity for a lump sum price without any reference to the cost, this is not a Murabaha, even though he is earning some profit on his cost, because the sale is not based on a cost-plus concept. In this case, the sale is called musawama. This is the actual sense of the term Murabaha, which is a sale, pure and simple. However, this kind of sale is being used by the Islamic banks and financial institutions by adding some other concepts to it as a mode of financing. But the validity of such transactions depends on some conditions which should be duly observed to make them acceptable in Sharia. In order to understand these conditions correctly, one should, in the first instance, appreciate that Murabaha is a sale with all its implications, and that all the basic ingredients of a valid sale should be present in Murabaha also. Therefore, this discussion will start with some fundamental rules of sale without which a sale cannot be held as valid in Sharia. Then, we shall discuss some special rules governing the sale of Murabaha in particular, and in the end the correct procedure for using the Murabaha as an acceptable mode of financing will be explained. An attempt has been made to reduce the detailed principles into concise notes in the shortest possible sentences, so that the basic points of the subject may be grasped at in one glance, and may be preserved for easy reference. Some basic rules of sale. Sale is defined in Sharia as the exchange of a thing of value by another thing of value with mutual consent. Islamic jurisprudence has laid down enormous rules governing the contract of sale, and the Muslim jurists have written a large number of books, in number of volumes, to elaborate them in detail. What is meant here is to give a summary of only those rules which are more relevant to the transactions of Murabaha as carried out by financial institutions. 1. The subject of sale must be existing at the time of sale. Thus, a thing which has not yet come into existence cannot be sold. If a non-existent thing has been sold, though by mutual consent, the sale is void according to Sharia. Example: A sells the unborn calf of his cow to B. The sale is void. 2. The subject of sale must be in the ownership of the seller at the time of the sale. Thus, what is not owned by the seller cannot be sold. If he sells something before acquiring its ownership, the sale is void. Example: A sells to B a car which is presently owned by C, but A is hopeful that he will buy it from C, and shall deliver it to B subsequently. The sale is void, because the car was not owned by A at the time of sale. 3. The subject of sale must be in the physical or constructive possession of the seller when he sells it to another person. Constructive possession means a situation where the possessor has not taken the physical delivery of the commodity, yet the commodity has come into his control, and all the rights and liabilities of the commodity are passed on to him, including the risk of its destruction. Examples: A has purchased a car from B, B has not yet delivered it to A or to his agent. A cannot sell the car to C. If he sells it before taking its delivery from B, the sale is void. 2. A has purchased a car from B, B, after identifying the car has placed it in a garage to which A has free access and B has allowed him to take the delivery from that place whenever he wishes. Thus the risk of the car has passed on to A. The car is in the constructive possession of A. If A sells the car to C without acquiring physical possession, the sale is valid. Explanation 1. The gist of the rules mentioned in paragraphs 1 to 3 is that a person cannot sell a commodity unless 1. It has come into existence. 2. It is owned by the seller. 3. It is in the physical constructive possession of the seller. Explanation 2. There is a big difference between an actual sale and a mere promise to sell. The actual sale cannot be effected unless the above 3 conditions are fulfilled. However, one can promise to sell something which is not yet owned or possessed by him. This promise initially creates only a moral obligation on the promiser to fulfill his promise, which is normally not justiciable. Nevertheless, in certain situations, where such promises burden the promisee with some liability, it can be enforceable through the courts of law. In such cases the court may force the promiser to fulfill his promise, i.e. to effect the sale, and if he fails to do so, the court may order him to pay the promised the actual damages he has incurred due to the default of the promiser. But the actual sale will have to be effected after the commodity comes into the possession of the seller. This will require separate offer and acceptance, and unless the sale is effected in this manner, the legal consequences of the sale shall not follow. Exception: the rules mentioned in paragraphs 1 to 3 are relaxed with respect to 2 types of sale, namely a. Bait salam, b. Istisna. The rules of these 2 types will be discussed later in a separate chapter. 4. The sale must be instant and absolute. Thus a sale attributed to a future date or a sale contingent on a future event is void. If the parties wish to effect a valid sale, they will have to effect it afresh when the future dates comes or the contingency actually occurs. Examples: A says to B on the 1st of January, "I sell my car to you on the 1st of February." The sale is void, because it is attributed to a future date. 2. A says to B, "If party X wins the elections, my car stands sold to you." The sale is void because it is contingent on a future event. 5. The subject of sale must be a property of value. Thus, a thing having no value according to the usage of trade cannot be sold or purchased. 6. The subject of sale should not be a thing which is not used except for a haram purpose, like pork, wine, etc. 7. the subject of sale must be specifically known and identified to the buyer. Explanation: the subject of sale may be identified either by pointation or by detailed specification which can distinguish it from other things not sold. Example: there is a building comprising of a number of apartments built in the same pattern. I, the owner of the building, says to B, I sell one of these apartments to you. B accepts. The sale is void unless the apartment intended to be sold is specifically identified or pointed out to the buyer. 8. The delivery of the sold commodity to the buyer must be certain and should not depend on a contingency or chance. Example: A sells his car stolen by some anonymous person and the buyer purchases it under the hope that he will manage to take it back. The sale is void. 9. The certainty of price is a necessary condition for the validity of a sale. If the price is uncertain, the sale is void. Example: I says to B, if you pay within a month, the price is 50 rupees. But if you pay after 2 months, the price is 55 rupees. B agrees. The price is uncertain and the sale is void, unless any one of the two alternatives is agreed upon by the parties at the time of sale. 10. The sale must be unconditional. A conditional sale is invalid, unless the condition is recognized as a part of the transaction according to the usage of trade. Example: one who buys a car from B with a condition that B will employ his son in his firm. The sale is conditional, hence invalid. 2. Buys a refrigerator from B, with a condition that B undertakes its free service for 2 years. The condition, being recognized as part of the transaction, is valid and the sale is lawful. Bai Murabaha sale on deferred payment basis. 1. A sale in which the parties agree that the payment of price shall be deferred is called a Bai Murabaha. 2. Bai Murabaha is valid if the due date of payment is fixed in an unambiguous manner. 3. The due time of payment can be fixed either with reference to a particular date, or by specifying a period, like 3 months, but it cannot be fixed with reference to a future event the exact date of which is unknown or is uncertain. If the time of payment is unknown or uncertain, the sale is void. 4. If a particular period is fixed for payment, like 1 month, it will be deemed to commence from the time of delivery, unless the parties have agreed otherwise. 6. Once the price is fixed, it cannot be decreased in case of earlier payment, nor can it be increased in case of default. 10. The buyer can also be asked to sign a promissory note or a bill of exchange, but the note or the bill cannot be sold to a third party at a price different from its face value. 7. In order to pressurize the buyer to pay the installments promptly, the buyer may be asked to promise that in case of default, he will donate some specified amount for a charitable purpose. In this case, the seller may receive such amount from the buyer, not to make it part of his income, but to use it for a charitable purpose on behalf of the buyer. 8. If the commodity is sold on installments, the seller may put a condition on the buyer that if he fails to pay any installment on its due date, the remaining installments will become due immediately. 9. In order to secure the payment of price, the seller may ask the buyer to furnish a security, whether in the form of a mortgage or in the form of lien or a charge on any of his existing assets. Murabaha Sukuk. 1. Murabaha is a particular kind of sale where the seller expressly mentions the cost of the sold commodity he has incurred, and sells it to another person by adding some profit or markup thereon. 2. The profit in Murabaha can be determined by mutual consent, either in lump sum or through an agreed ration of profit to be charged over the costs. 3. All the expenses incurred by the seller in acquiring the commodity, like freight, custom duty, etc., shall be included in the cost price, and the markup can be applied on the aggregate cost. However, recurring expenses of the business like salaries of the staff, the rent of the premises, etc. cannot be included in the cost of an individual transaction. In fact, the profit claimed over the cost takes care of these expenses. 4. Murabaha is valid only where the exact cost of a commodity can be ascertained. If the exact cost cannot be ascertained, the commodity cannot be sold on Murabaha basis. In this case, the commodity must be sold on Musawama bargaining basis, i.e. without any reference to the cost or to the ratio of profit markup. The price of the commodity in such cases shall be determined in lump sum by mutual consent. Example 1. A purchased a pair of shoes for 100 rupees. He wants to sell it on Murabaha with 10% markup. The exact cost is known. The Murabaha sale is valid. Example 2. Client purchased a ready-made suit with a pair of shoes in a single transaction, for a lump sum price of 500 rupees. The client can sell the suit including shoes on Murabaha. But he cannot sell the shoes separately on Murabaha, because the individual cost of the shoes is unknown. If he wants to sell the shoes separately, he must sell it at a lump sum price without reference to the cost or to the markup. Murabaha is a mode of financing. Originally, Murabaha is a particular type of sale and not a mode of financing. The ideal mode of financing according to Sharia is Mudaraba or Musharaka, which have been discussed in the first chapter. However, in the perspective of the current economic setup, there are certain practical difficulties in using Mudaraba and Musharaka instruments in some areas of financing. Therefore, the contemporary Sharia experts have allowed, subject to certain conditions, the use of Murabaha on deferred payment basis as a mode of financing. But there are two essential points which must be fully understood in this respect. 1. It should never be overlooked that, originally Murabaha is not a mode of financing. It is only a device to escape from interest and not an ideal instrument for carrying out the real economic objectives of Islam. Therefore, this instrument should be used as a transitory step taken in the process of Islamization of the economy, and its use should be restricted only to those cases where Mudaraba or Musharaka are not practicable. 2. The second important point is that the Murabaha transaction does not come into existence by merely replacing the word of interest by the words of profit or markup. Actually, Murabaha as a mode of finance has been allowed by the Sharia scholars with some conditions. Unless these conditions are fully observed, Murabaha is not permissible. In fact, it is the observance of these conditions which can draw a clear line of distinction between an interest-bearing loan and a transaction of Murabaha. If these conditions are neglected, the transaction becomes invalid according to Sharia. Basic features of Murabaha financing. 1. Murabaha is not a loan given on interest. It is the sale of a commodity for a deferred price which includes an agreed profit added to the cost. 2. Being a sale, and not a loan, the Murabaha should fulfill all the conditions necessary for a valid sale, especially those enumerated earlier in this chapter. 3. Murabaha cannot be used as a mode of financing except where the client needs funds to actually purchase some commodities. For example, if he wants funds to purchase cotton as a raw material for his ginning factory, the bank can sell him the cotton on the basis of Murabaha. But where the funds are required for some other purposes, like paying the price of commodities already purchased by him, or the bills of electricity or other utilities, or for paying the salaries of his staff, Murabaha cannot be effected, because Murabaha requires a real sale of some commodities, and not merely advancing a loan. 4. The financier must have owned the commodity before he sells it to his client. 5. The commodity must come into the possession of the financier, whether physical or constructive, in the sense that the commodity must be in his risk, though for a short period. 6. The best way for Murabaha, according to Sharia, is that the financier himself purchases the commodity and keeps it in his own possession, or purchases the commodity through a third person appointed by him as agent before he sells it to the customer. However, in exceptional cases, where direct purchase from the supplier is not practicable for some reason, it is also allowed that he makes the customer himself his agent to buy the commodity on his behalf. In this case, the client first purchases the commodity on behalf of his financier and takes its possession as such. Thereafter, he purchases the commodity from the financier for a deferred price. His possession over the commodity in the first instance is in the capacity of an agent of his financier. In this capacity he is only a trustee, while the ownership vests in the financier and the risk of the commodity is also borne by him as a logical consequence of the ownership. But when the client purchases the commodity from his financier, the ownership, as well as the risk, is transferred to the client. 7. As mentioned earlier, the sale cannot take place unless the commodity comes into the possession of the seller, but the seller can promise to sell even when the commodity is not in his possession. The same rule is applicable to Murabaha. 8. In the light of the aforementioned principles, a financial institution can use the Murabaha as a mode of finance by adopting the following procedure. First, the client and the institution sign an overall agreement whereby the institution promises to sell and the client promises to buy the commodities from time to time on an agreed ratio of profit added to the cost. This agreement may specify the limit up to which the facility may be availed. Second, when a specific commodity is required by the customer, the institution appoints the client as his agent for purchasing the commodity on its behalf, and an agreement of agency is signed by both the parties. Third, the client purchases the commodity on behalf of the institution and takes its possession as an agent of the institution. Fourth, the client informs the institution that he has purchased the commodity on his behalf, and at the same time, makes an offer to purchase it from the institution. Fifth, the institution accepts the offer and the sale is concluded whereby the ownership as well as the risk of the commodity is transferred to the client. All these 5 stages are necessary to effect a valid Murabaha. If the institution purchases the commodity directly from the supplier, which is preferable, it does not need any agency agreement. In this case, the second phase will be dropped, and at the third stage the institution itself will purchase the commodity from the supplier, and the fourth phase will be restricted to making an offer by the client. The most essential element of the transaction is that the commodity must remain in the risk of the institution during the period between the third and fifth stage. This is the only feature of Murabaha which can distinguish it from an interest-based transaction. Therefore, it must be observed with due diligence at all costs, otherwise the Murabaha transaction becomes invalid according to Sharia. 9. It is also a necessary condition for the validity of Murabaha that the commodity is purchased from a third party. The purchase of the commodity from the client himself on buyback agreement is not allowed in Sharia. Thus, Murabaha based on buyback agreement is nothing more than an interest-based transaction. 10. The above-mentioned procedure of the Murabaha financing is a complex transaction where the parties involved have different capacities at different stages. First, the institution and the client promise to sell and purchase a commodity in future. This is not an actual sale. It is just a promise to effect a sale in the future on Murabaha basis. Thus, at this stage the relation between the bank and client is a promisor and a promisee. Second, at the second stage, the relation between the parties is that of a principal and an agent. Third, at the third stage, the relation between the institution and the supplier is that of a buyer and seller. Fourth, at the fourth and fifth stage, the relation between the institution and supplier is that of buyer and seller comes into operation between the institution and the client, and since the sale is effected on deferred payment basis, the relation of a debtor and creditor also emerges between them simultaneously. All these capacities must be kept in mind and must come into operation with all their consequential effects, each at its relevant stage, and these different capacities should never be mixed up or confused with each other. 11. The institution may ask the client to furnish a security to its satisfaction for the prompt payment of the deferred price. He may also ask him to sign a promissory note or bill of exchange, but it must be after the actual sale takes place, i.e. at the fifth stage mentioned above. The reason is that the promissory note is signed by a debtor in favor of his creditor, but the relation of debtor and creditor between the institution and the client begins only at the fifth stage, whereupon the actual sale takes place between them. 12. In the case of default by the buyer in the payment of price at the due date, the price cannot be increased. However, if he has undertaken an agreement to pay an amount for a charitable purpose, as mentioned in the rules of Bai Murabaha, he shall pay the amount undertaken by him. But the amount so recovered from the buyer shall not form part of the income of the seller, the financier. He is bound to spend it for a charitable purpose on behalf of the buyer. Some issues involved in Murabaha. So far the basic concept of Murabaha has been explained. Now, it is proposed to discuss some relevant issues with reference to the underlying Islamic principles and their practical applicability in Murabaha transactions, because without correct understanding of these issues, the concept may remain ambiguous and its practical application may be susceptible to errors and misconceptions. Issue 1. Different pricing for cash and credit sales. The first and foremost question about Murabaha is that, when used as a mode of financing, it is always effected on the basis of deferred payment. The financier purchases the commodity on cash payment and sells it to the client on credit. While selling the commodity on credit, he takes into account the period in which the price is to be paid by the client and increase the price accordingly. The longer the maturity of the Murabaha payment, the higher the price. Therefore, the price in a Murabaha transaction, as practiced by the Islamic banks, is always higher than the market price. If the client is able to purchase the same commodity from the market on cash payment, he will have to pay much less than he has to pay in a Murabaha transaction on deferred payment basis. The question arises as to whether the price of a commodity in a credit sale may be increased from the price of the cash sale. Some people argue that the increase of price in a credit sale, being in consideration of the time given to the purchaser, should be treated analogous to the interest charged on a loan, because in both cases an additional amount is charged for the deferment of payment. On this basis they argue that the Murabaha transactions, as practiced in the Islamic banks, are not different in essence from the interest-based loans advanced by conventional banks. This argument, which seems to be logical in appearance, is based on a misunderstanding about the principles of Sharia regarding the prohibition of riba. For the correct comprehension of the concept, the following points must be kept in view. The modern capitalist theory does not differentiate between money and commodity insofar as commercial transactions are concerned. In the matter of exchange, money and commodity both are treated at par. Both can be traded in. Both can be sold at whatever price the parties agree upon. One can sell $1 for $2 on the spot as well as on credit, just as he can sell a commodity valuing $1 for $2. The only condition is that it should be with mutual consent. The Islamic principles, however, do not subscribe to this theory. According to Islamic principles, money and commodity have different characteristics and therefore, they are treated differently. The basic points of difference between money and commodity are the following. 1. Money has no intrinsic utility. It cannot be utilized for fulfilling human needs directly. It can only be used for acquiring some goods or services. The commodities, on the other hand, have intrinsic utility. They can be utilized directly without exchanging them for some other thing. 2. The commodities can be of different qualities, while money has no quality except that it is a measure of value or the medium of exchange. Therefore, all the units of money, of same denomination, are 100% equal to each other. An old and dirty note of 1,000 rupees has the same value as a brand new note of 1,000 rupees, unlike the commodities which may have different qualities, and obviously an old and used car may be much less in value than a brand new car. 3. In commodities, the transaction of sale and purchase is effected on a particular individual commodity, or at least, on the commodities having particular specifications. If A has purchased a particular car by pinpointing it and seller has agreed, he deserves to receive the same car. The seller cannot compel him to take the delivery of another car, though of the same type or quality. This can only be done if the purchaser agrees to it, which implies that the earlier transaction is cancelled and a new transaction on the new car is effected by mutual consent. Money, on the contrary, cannot be pinpointed in a transaction of exchange. If a buyer has purchased a commodity from a seller by showing him a particular note of 1,000 rupees, he can still pay him another note of the same denomination, while the seller cannot insist that he will take the same note as was shown to him. Keeping these differences in view, Islam has treated money and commodities differently. Since money has no intrinsic utility, but is only a medium of exchange which has no different qualities, the exchange of a unit of money for another unit of the same denomination cannot be effected except at par value. If a currency note of Malaysian ringgit 1,000 is exchanged for another note of Malaysian ringgit, it must be of the value of Mr 1,000. The price of the former note can neither be increased nor decreased from Mr 1,000 even in a spot transaction, because the currency note has no intrinsic utility nor a different quality recognized legally. Therefore any excess on either side is without consideration, hence not allowed in Sharia. As this is true in a spot exchange transaction, it is also true in a credit transaction where there is money on both sides, because if some excess is claimed in a credit transaction where money is exchanged for money, it will be against nothing but time. The case of the normal commodities is different. Since they have intrinsic utility and have different qualities, the owner is at liberty to sell them at whatever price he wants, subject to the forces of supply and demand. If the seller does not commit a fraud or a misrepresentation, he can sell a commodity at a price higher than the market rate with the consent of the purchaser. If the purchaser accepts to buy it at that increased price, the excess charged from him is quite permissible for the seller. When he can sell his commodity at a higher price in a cash transaction, he can also charge a higher price in a credit sale, subject only to the condition that he neither deceives the purchaser nor compels him to purchase, and the buyer agrees to pay the price with his free will. It is sometimes argued that the increase of price in a cash transaction is not based on the deferred payment, therefore it is permissible, while in a sale based on deferred payment, the increase is purely against time, which makes it analogous to interest. This argument is again based on the misconception that whenever price is increased taking the time of payment into consideration, the transaction comes within the ambit of interest. This presumption is not correct. Any excess amount charged against late payment is riba only where the subject matter is money on both sides. But if a commodity is sold in exchange of money, the seller, when fixing the price, may take into consideration different factors, including the time of payment. A seller, being the owner of a commodity which has intrinsic utility, may charge a higher price and the purchaser may agree to pay it due to various reasons. For example, 1. His shop is nearer to the buyer who does not want to go to the market which is not so near. 2. The seller is more trustworthy for the purchaser than others, and the purchaser has more confidence in him that he will give him the required thing without any defect. 3. The seller gives him priority in selling commodities having more demand. 4. The atmosphere of the shop of the seller is cleaner and more comfortable than other shops. 5. The seller is more courteous in his dealings than others. These and similar other considerations play their role in charging a higher price from the customer. In the same way, if a seller increases the price because he allows credit to his client, it is not prohibited by Sharia if there is no cheating and the purchaser accepts it with open eyes, because whatever the reason of increase, the whole price against a commodity and not against money. It is true that, while increasing the price of the commodity, the seller is kept in view the time of its payment, but once the price is fixed, it relates to the commodity, and not to the time. That is why if the purchaser fails to pay at a stipulated time, the price will remain the same and can never be increased by the seller. Had it been against time, it might have been increased, if the seller allows him more time after the maturity. To put it another way, since money can only be traded in at par value, as explained earlier, any excess claimed in a credit transaction of money exchange of money is against nothing but time. That is why if the debtor is allowed more time at maturity, some more money is claimed from him. Conversely, in a credit sale of a commodity, time is not the exclusive consideration while fixing the price. The price is fixed for the commodity, not for time. However, time may act as an ancillary factor to determine the price of the commodity, like any other factor from those mentioned above, but once this factor has played its role, every part of the price is attributed to the commodity. The upshot of this discussion is that when the money is exchanged for money, no excess is allowed, neither in cash transaction, nor in credit, but where a commodity is sold for money, the price agreed upon by the parties may be higher than the market price, both in cash and credit transactions. Time of payment may act as an ancillary factor to determine the price of a commodity, but it cannot act as an exclusive basis for the sole consideration of an excess claimed in exchange of money for money. This position is accepted unanimously by all the four schools of Islamic law and the majority of the Muslim jurists. They say that if a seller determines two different prices for cash and credit sales, the price of the credit sale being higher than the cash price, it is allowed in Sharia. The only condition is that at the time of the actual sale, one of the two options must be determined, leaving no ambiguity in the nature of the transaction. For example, it is allowed for the seller, at the time of bargaining, to say to purchaser, if you purchase the commodity on cash payment, the price would be Mr. 100, and if you purchase it on credit of 6 months, the price would be Mr. 110. But the purchaser shall have to select either of the two options. He should say that he would purchase it on credit for Mr. 110. Thus, at the time of the actual sale, the price will be known to both parties. However, if either of the two options is not determined in specific terms, the sale will not be valid. This may happen in those installment sales in which different prices are claimed for different maturities. In this case, the seller draws a schedule of prices according to schedule of payment. For example, Mr. 1000 are charged for the credit of 3 months, Mr. 1100 for the credit of 6 months, Mr. 1200 for 9 months and so on. The purchaser takes the commodity without specifying the option he will exercise, on the assumption that he will pay the price in future according to his convenience. This transaction is not valid, because the time of payment, as well as the price, is not determined. But if he chooses one of these options specifically and says, for example, that he purchases the commodity on 6 months credit with a price of 1100, the sale will be valid. Another point must be noted here. What has been allowed above is that the price of the commodity in a credit sale is fixed at more than the cash price. But if the sale has taken place at cash price, and the seller has imposed a condition that in case of late payment, he will charge 10% per annum as a penalty or as interest, this is totally prohibited, because what is being charged is not a part of the price, it's an interest charged on a debt. The practical difference between the two situations is that where the additional amount is a part of the price, it may be charged on a one-time basis only. If the purchaser fails to pay it on time, the seller cannot charge another additional amount. The price will remain the same without any addition. Conversely, where the additional amount is not a part of the price, it will keep increasing with the period of default. Issue 2. The use of interest rate as a benchmark. Many institutions financing by way of Murabaha determine their profit or markup on the basis of the current interest rate, mostly using LIBOR interbank offered rate in London as the criterion. For example, if LIBOR is 6%, they determine their markup on Murabaha equal to LIBOR or some percentage above LIBOR. This practice is often criticized on the ground that profit based on a rate of interest should be prohibited as interest itself. No doubt, the use of the rate of interest for determining a halal profit cannot be considered desirable. It certainly makes the transaction resemble an interest-based financing, at least in appearance, and keeping in view the severity of prohibition of interest, even this apparent resemblance should be avoided as far as possible. But one should not ignore the fact that the most important requirement for validity of Murabaha is that it is a genuine sale with all its ingredients and necessary consequences. If a Murabaha transaction fulfills all the conditions enumerated, merely using the interest rate as a benchmark for determining the profit of Murabaha does not render the transaction invalid, haram or prohibited, because the deal itself does not contain interest. The rate of interest has been used only as an indicator or as a benchmark. In order to explain the point, let me give an example. X and Y are two brothers. X trades in liquor, which is totally prohibited in Sharia. Y, being a practicing Muslim, dislikes the business of X and starts the business of soft drinks, but he wants his business to earn as much profit as X earns through trading in liquor. Therefore he resolves that he will charge the same rate of profit from his customers as X charges over the sale of liquor. Thus he has tied up his rate of profit with the rate used by X in his prohibited business. One may question the propriety of his approach in determining the rate of his profit, but obviously no one can say that the profit charged by him in his halal business is haram, because he used the rate of profit of the business of liquor as a benchmark. Similarly, so far as the transaction of Murabaha is based on Islamic principles and fulfills all its necessary requirements, the rate of profit determined on the basis of the rate of interest will not render the transaction as haram. It is, however, true that the Islamic banks and financial institutions should get rid of this practice as soon as possible, because, firstly, it takes the rate of interest as an ideal for halal business which is not desirable, and secondly because it does not advance the basic philosophy of Islamic economy, having no impact on the system of distribution. Therefore, the Islamic banks and financial institutions should strive for developing their own benchmark. This can be done by creating their own interbank market based on Islamic principles. The purpose can be achieved by creating a common pool which invests in asset-backed instruments like musharaka, ijara, etc. If majority of the assets of the pool is in tangible form, like leased property or equipment, shares in business concerns etc., its units can be sold and purchased on the basis of their net asset value determined on periodical basis. These units may be negotiable and may be used for overnight financing as well. The banks having surplus liquidity can purchase these units, and when they need liquidity, they can sell them. This arrangement may create interbank market, and the value of the units may serve as an indicator for determining the profit in Murabaha and leasing also. Issue 3. Promise to purchase. Another important issue in Murabaha financing which has been subject of debate between the contemporary Sharia scholars is that the bank financier cannot enter into an actual sale at a time when the client seeks Murabaha financing from him, because the required commodity is not owned by the bank at this stage, and, as explained earlier, one cannot sell a commodity not owned by him, nor can he effect a forward sale. He is, therefore, bound to purchase the commodity from the supplier, then he can sell it to the client after having its physical or constructive possession. On the other hand, if the client is not bound to purchase the commodity after the financier has purchased it from the supplier, the financier may be confronted with a situation where he has incurred huge expenses to acquire the commodity, but the client refuses to purchase it. The commodity may be of such a nature that it has no common demand in the market and is very difficult to dispose of. In this case, the financier may suffer unbearable loss. Solution to this problem is sought in the Murabaha arrangement by asking the client to sign a promise to purchase the commodity when it is acquired by the financier. Instead of being a bilateral contract of forward sale, it is a unilateral promise from the client which binds himself and not the financier. Being a one-sided promise, it is distinguishable from the bilateral forward contract. This solution is subjected to the objection that a unilateral promise creates a moral obligation, but it cannot be enforced, according to Sharia, by the courts of law. This leads us to the question whether or not a one-sided promise is enforceable in Sharia. The general impression is that it is not, but before accepting this impression at its face value, we will have to examine it in the light of the original sources of Sharia. A thorough study of the relevant material in the books of Islamic jurisprudence would show that the fuqaha, the Muslim jurists, have different views on the subject. Their views may be summarized as follows. View 1. Many of them are of the opinion that fulfilling a promise is a noble quality and it is advisable for the promiser to observe it, and its violation is reproachable, but it is neither mandatory wajib, nor enforceable through courts. This view was attributed to Imam Abu Hanifa, Imam al-Shafi'i, Imam Ahmad, and to some Maliki jurists. However, as will be shown later, many Hanafis and Malikis and some Shafi'i jurists do not subscribe to this view. View 2. A number of the Muslim jurists are of the view that fulfilling a promise is mandatory and a promiser is under moral as well as legal obligation to fulfill his promise. According to them, promise can be enforced through courts of law. This view is ascribed to Samura bin Dub, the well-known companion of the Holy Prophet S.W. Umar bin Abdul Aziz, Hassan al-Basri, Sa'id bin al-Ashwa, Ishaq bin Raway, and Imam al-Bukhari. The same is the view of some Maliki jurists, and it is preferred by Ibn al-Arabi and Ibn al-Shat, and endorsed by al-Ghazali, the famous Shafi'i jurist, who says the promise is binding if it is made in absolute terms. The same is the view of Ibn Shabruma. The third view was presented by some Maliki jurists. They say that in normal conditions, promise is not binding, but if the promiser has caused the promisee to incur some expenses or undertake some labor or liability on the basis of promise, it is mandatory on him to fulfill his promise, for which he may be compelled by the courts. Some contemporary scholars have claimed that the jurists who have accepted the binding nature of a promise have done so only with regard to unilateral gifts or other voluntary payments, but none of them has accepted the binding nature of a promise to effect a bilateral commercial or monetary transaction. However, based on a close study, this notion does not seem to be correct, because the Maliki and Hanafi jurists have allowed Bai Wafa on the basis of binding promise. Bai Wafa is a special kind of sale whereby the purchaser of an immovable property undertakes that whenever the seller will give him the price back, he will sell the house to him. The gist of the discussion is that if repurchase by the seller is made a condition for the original sale, it is not a valid transaction, but if the parties have entered into the original sale unconditionally, but the seller has signed a separate and independent promise to repurchase the sold property, this promise will be binding on the promisor and enforceable through the courts. The binding nature of the promise in this case has been admitted by both Maliki and Hanafi jurists. Obviously, this promise does not relate to a gift. It is a promise to effect a sale in future. Still, the Maliki and Hanafi jurists have accepted it as binding on the promisor and enforceable through the courts. It is a clear proof of the fact that the jurists who hold the promises to be binding do not restrict it to the promises of gifts, etc. The same principle is applicable, according to them, to the promises whereby the promisor undertakes to enter into a bilateral contract in future. In fact, the Holy Quran and the Sunnah of the Holy Prophet SW are very particular about fulfilling promises. The Holy Quran says, "And fulfill the covenant." Surely, the covenant will be asked about in the hereafter. Bani Israel 34. O those who believe, why do you say what you not do? It invites Allah's anger that you say what you not do. Al-Saf 2-3. Imam Abu Bakr al-Jassas has said that this verse of the Holy Quran indicates that if one undertakes to do something, no matter whether it is a worship or a contract, it is obligatory on him to do it. The Holy Prophet SW is reported to have said, "There are three distinguishing features of a hypocrite: when he speaks, tells a lie; when he promises, he backs out; and when he is given something in trust, he breaches the trust." This is only one example. There is a large number of injunctions in the Ahadith of the Holy Prophet SW where it is ordained to fulfill the promises, and it is clearly prohibited to back out, except for a valid reason. Therefore, it is evident from these injunctions that fulfilling promise is obligatory. However, the question whether or not a promise is enforceable in courts depends on the nature of the promise. There are certainly some sorts of promises which cannot be enforced through courts. For example, at the time of engagement the parties promise to go through the marriage. These promises create a moral obligation, but obviously they cannot be enforced through courts of law. But in commercial dealings, where a party has given an absolute promise to sell or purchase something and the other party has incurred liabilities on that basis, there is no reason why such a promise should not be enforced. Therefore, on the basis of the clear injunctions of Islam, if the parties have agreed that this particular promise will be binding on the promisor, it will be enforceable. This is not a question pertaining to Murabaha alone. If promises are not enforceable in the commercial transactions, it may seriously jeopardize commercial activities. If somebody orders a trader to bring from him a certain commodity and promises to purchase it from him, on the basis of which the trader imports it from abroad by incurring huge expenses, how can it be allowed for the former to refuse to purchase it? It is only on these grounds that the Islamic Fiqh Academy Jeddah has made the promises in commercial dealings binding on the promisor with the following conditions. 1. It should be one-sided promise. 2. The promise must have caused the promisee to incur some liabilities. 3. Take place at the appointed time by the exchange of offer and acceptance. Mere promise itself should not be taken as the concluded sale. 4. If the promiser backs out of his promise, the court may force him either to purchase the commodity or pay actual damages to the seller. The actual damages will include the actual monetary loss suffered by him, but will not include the opportunity cost. On this basis, it is allowed that the client promises to the financier that he will purchase the commodity after the latter acquires it from the supplier. This promise will be binding on him and may be enforced through courts in the manner explained above. This promise does not amount to the actual sale. It will be simply a promise, and the actual sale will take place after the commodity is acquired by the financier, for which exchange of offer and acceptance will be necessary. Securities against Murabaha price. Another issue regarding Murabaha financing is that the Murabaha price is payable at a later date. The seller financier naturally wants to make sure that the price will be paid at the due date. For this purpose, he may ask the client to furnish a security to his satisfaction. The security may be in the form of a mortgage or a hypothecation or some kind of lien or charge. Some basic rules about this security must, therefore, be kept in mind. Rule 1. The security can be claimed rightfully where the transaction has created a liability or a debt. No security can be asked from a person who has not incurred a liability or debt. As explained earlier, the procedure of Murabaha financing comprises of different transactions carried out at different stages. In the earlier stages of the procedure, the client does not incur a debt. It is only after the commodity is sold to him by the financier on credit that the relationship of a creditor and a debtor comes into existence. Therefore, the proper way in a transaction of Murabaha would be that the financier asks for a security after he has actually sold the commodity to the client and the price has become due on him, because at this stage the client incurs a debt. However, it is also permissible that the client furnishes a security at earlier stages, but after the Murabaha price is determined. In this case, if the security is possessed by the financier, it will remain at his risk, meaning thereby that if it is destroyed before the actual sale to the client, he will have either to pay the market price of the mortgaged asset and cancel the agreement of Murabaha, or sell the commodity required by the client and deduct the market price of the mortgaged asset from the price of the sold property. Rule 2. It is also permissible that the sold commodity itself is given to the seller as a security. Some scholars are of the opinion that this can only be done after the purchaser has taken its delivery and not before. It means that the purchaser shall take its delivery, either physical or constructive, from the seller, then give it back to him as mortgage, so that the transaction of mortgage is distinguished from the transaction of sale. However, after studying the relevant material, it can be concluded that the earlier jurists have put this condition in cash sales only and not in credit sales. Therefore, it is not necessary that the purchaser takes the delivery of the sold property before he surrenders it as mortgage to the seller. The only requirement would be that the point of time whereby the property is held to be mortgaged should necessarily be specified, because from that point of time, the property will be held by the seller in a different capacity which should be clearly earmarked. For example, X sold a car to Y on 1st of January for a price of Mr. 500,000 to be paid on June 30th. X asked Y to give a security for payment at the due date. Y has not yet taken delivery of the car, and he offered to X that he should keep the car as mortgage from January 2nd. If the car is destroyed before January 2nd, the sale will be terminated and nothing will be payable by Y. But if the car is destroyed after the 2nd of January, sale is not terminated, but it will be subject to the rules prescribed for the destruction of a mortgage. According to Hanafi jurists, in this case, the seller will have to bear the loss of the car, to the extent of its market price or its agreed sale price, whichever is lesser. Therefore, if the market price of the car was $450,000, he can claim only the remaining part of the agreed sale price, i.e. MR.50000. If the market price of the car is MR $500,000 or higher, nothing can be claimed from the purchaser. This is the view of the Hanafi school. The Shafi'i and Hanbali jurists hold that if the car is destroyed by the negligence of the mortgagee, he will have to bear the loss, according to its market price, but if the car is destroyed without any fault on his part, he will not be liable to anything, and the purchaser will bear the loss and will have to pay the full price. It is clear from the above example that the possession of X over the car as a seller carries effects and consequences different from his possession as a mortgagee, and therefore it is necessary that the point of time on which the car is held by him as a mortgagee should clearly be defined. Otherwise, different capacities will be mixed up, giving rise to dispute and rendering the security invalid. Issue 5. Guaranteeing the Murabaha. The seller in a Murabaha financing can so ask the purchaser client to furnish a guarantee from a third party. In case of default in the payment of price at the due date, the seller may have recourse to the guarantor, who will be liable to pay the amount guaranteed by him. The rules of Sharia regarding guarantee are fully discussed in the books of Islamic fiqh. However, I would point out to two burning issues in the context of Islamic banking. First issue, the guarantor in the contemporary commercial atmosphere does not normally guarantee a payment without a fee charged from the original debtor. The classical fiqh literature is almost unanimous on the point that the guarantee is a voluntary transaction and no fee can be charged on a guarantee. The most the guarantor can do is to claim his actual secretarial expenses incurred in offering the guarantee, but the guarantee itself should be free of charge. The reason for this prohibition is that the person who advances money to another person as a loan cannot charge a fee for advancing a loan, because it falls under the definition of riba, or interest, which is prohibited. The guarantor should be subject to this prohibition all the more, because he does not advance money. He only undertakes to pay a certain amount on behalf of the original debtor in case he defaults in payment. If the person who actually pays money cannot charge a fee, how can fee be charged by a person who has merely undertaken to pay and did not pay anything in actual terms? Suppose X has borrowed $100 from Y, who asked him to produce a guarantor. Z says to X, "I pay off your debt to Y right now, but you will have to pay me $110 at a later date." Obviously, $10 charged from X are not allowed, being interest. Then V comes to X and says, "I stand as a guarantor to you, but you will have to pay me $10 for this service." If we allow to charge a fee for guarantee, it will mean that Z cannot charge $10 despite the fact that he has actually paid the amount, and V can charge $10 despite the fact that he is merely committed to pay only when X fails to pay. This being unfair, apparently, the Muslim jurists have forbidden the charging of a fee for guarantee, so that both Z and V, in the above example, may stand on equal footing. Second issue, however, some contemporary scholars are considering the problem from a different angle. They feel that guarantee has become a necessity, especially in international trade where the sellers and the buyers do not know each other, and the payment of the price by the purchaser cannot be simultaneous with the supply of the goods. There has to be an intermediary who can guarantee the payment. It is utterly difficult to find the guarantors who can provide this service free of charge in required numbers. Keeping these realities in view, some Sharia scholars of our time are adopting a different approach. They say the prohibition of guarantee fee is not based on any specific injunction of the Holy Quran or the Sunnah of the Holy Prophet SW. It has been deducted from the prohibition of riba as one of its ancillary consequences. Moreover, guarantees in the past were of a simple nature. In today's commercial activities, the guarantor sometimes needs a number of studies and a lot of secretarial work. Therefore, they opine, the prohibition of the guarantee fee should be reviewed in this perspective. The question still needs further research and should be placed before a larger forum of scholars. However, unless a definite ruling is given by such a forum, no guarantee fee should be charged or paid by an Islamic financial institution. Instead, they can charge or pay a fee to cover expenses incurred in the process of issuing a guarantee. Issue 6. Penalty of default. Another problem in Murabaha financing is that if a client defaults in payment of the price at the due date, the price cannot be increased. In interest-based loans, the amount of loan keeps on increasing according to the period of default. But, in Murabaha financing, once the price is fixed, it cannot be increased. This restriction is sometimes exploited by dishonest clients who deliberately avoid to pay the price at its due date, because they know that they will not have to pay any additional amount on account of default. This characteristic of Murabaha should not create a big problem in a country where all banks and financial institutions are run on Islamic principles, because the government or the central bank may develop a system where such defaulters may be penalized by depriving them from obtaining any facility from any financial institution. This system may serve as deterrent against deliberate defaults. However, in the countries where the Islamic banks and financial institutions are working in isolation from the majority of financial institutions run on the basis of interest, this system can hardly work, because even if the client is deprived to avail of a facility from an Islamic bank, he can approach the conventional institutions. In order to solve this problem, some contemporary scholars have suggested that the dishonest clients who default in payment deliberately should be made liable to pay compensation to the Islamic bank for the loss it may have suffered on account of default. They suggest that the amount of this compensation may be equal to the profit given by that bank to its depositors during the period of default. For example, the defaulter has paid the price 3 months after the due date. If the bank has given to its depositors a profit at the rate of 5%, the client has to pay 5% more as compensation for the loss of the bank. However, the scholars who allow this compensation make it subject to the following conditions. Condition 1. The defaulter should be given a grace period of at least 1 month after the maturity date, during which he must be given weekly notices warning him that he should pay the price, otherwise he will have to pay compensation. Condition 2. It is proved beyond doubt that the client is defaulting without valid excuse. If it appears that his default is due to poverty, no compensation can be claimed from him. Indeed, he must be given respite until he is able to pay, because the Holy Quran has expressly said, "And if he the debtor is short of funds, then he must be given respite until he is well off." 2:280. Condition 3. The compensation is allowed only if the investment account of the Islamic bank has earned some profit to be distributed to the depositors. If the investment account of the bank has not earned profit during the period of default, no compensation shall be claimed from the client. This concept of compensation, however, is not accepted by the majority of the present-day scholars. It is the considered opinion of such scholars that this suggestion neither conforms to the principles of Sharia nor is it able to solve the problem of default. First of all, any additional amount charged from a debtor is riba. In the days of Jahiliyyah before Islam, the people used to charge additional amounts from their debtors when they were not able to pay at the due date. They used to say, either you pay off your debt or you increase the payable amount. The aforementioned suggestion of paying compensation to the credit seller resembles the same attitude. It can be argued that the above suggestion is theoretically different from the practice of Jahiliyyah in that the suggestion is to grant the debtor a grace period of 1 month to make sure that he is avoiding payment without a valid cause and to exempt him from compensation if it appears that his non-payment is due to poverty or hardship. But in practical application of the concept, these conditions are hardly fulfilled, because every debtor may claim that his default is due to his financial inability at the due date, and it is very difficult for a financial institution to hold an inquiry about the final acquisition of each client and to verify whether or not he was able to pay. What the banks normally do is that they presume that every client was able to pay unless he has been declared as bankrupt or insolvent. It means that the concession allowed in the suggestion can be enjoyed by the insolvent people. Obviously, insolvency is a rare phenomenon, and in this rare situation, even the interest-based banks cannot normally recover interest from the borrower. Therefore, the suggestion leaves no practical and meaningful difference between an interest-based financing and an Islamic financing. So far as grace period is concerned, it is a minor concession which is sometimes given by the conventional banks as well. Once again, in practical terms, there is no material difference between interest and the late payment charged as compensation. It is argued in favor of charging compensation that the Holy Prophet Pbuh has condemned the person who delays the payment of his dues without a valid cause. According to the well-known hadith, he has said, "The well-off person who delays the payment of his debt subjects himself to punishment and disgrace." The argument runs that the Holy Prophet Pbuh has permitted to inflict a punishment on such a person. The punishments may be of different kinds, including the imposition of a monetary penalty. But this argument overlooks the fact that even if it is assumed that imposing fine or a monetary penalty is allowed in the Sharia, it is imposed by a court of law and is normally paid to the government. Nobody has allowed a situation where an aggrieved party imposes a fine on its own and for its own benefit without a judgment of a court competent to decide the matter. Moreover, had it been a recognized punishment, it should have been imposed even if the investment account has earned no profit during that period, because the guilt of the defaulter is established and it has no nexus with the profit of the investment account of the bank. In fact, the suggestion of the compensation equal to the rate of profit of the investment account is based on the concept of opportunity cost of money. This concept is foreign to the principles of Sharia. Islam does not recognize opportunity cost of money, because after the elimination of interest from the economy, money has no definite return. It is always exposed to loss as well as it has the ability to earn a profit. And it is the risk of loss which makes it entitled to gain a return. Another point is worth the attention. The one who defaults in the payment of debt is, at the most, like a thief or a usurper. But the study of the rules prescribed for theft and usurpation would show that a thief has been subjected to a very severe punishment of amputating his hands, but he was never asked to pay an additional amount to compensate the victim of theft. Similarly, if a person has usurped the money of another person, he may be punished by the way of ta'zir, but no Muslim jurist has ever imposed on him a financial penalty to compensate the owner. Imam al-Shafi'i is of the view that if someone usurps the land of another person, he will have to pay the rent of the land according to the market rate. But if he has usurped the money, he will return the equal amount of money and not more. All these rules go a long way to prove that the opportunity cost of money is never recognized by the Islamic Sharia, because, as explained above, money has no definite return or any intrinsic utility. On the basis of what is stated above, the idea of compensation to be charged from a defaulter is not approved by most of the contemporary scholars. The question was thoroughly discussed in the annual session of the Islamic Fiqh Academy, Jeddah, and it was resolved that no such compensation is allowed in Sharia. All this discussion relates to the impermissibility of the proposed compensation in Sharia. Now it is to be noted that this proposal does not solve the problem of default at all. To the contrary, it may encourage the debtors to commit as much default as they wish. The reason is that, according to this suggestion, the defaulter is asked to pay compensation equal to the return earned by the depositors during the period of default. It is evident that the rate of return earned by the depositors is always less than the rate of profit paid by the customer in a Murabaha transaction. Therefore, the customer will be paying after default, much less than he was paying before the default. Therefore, he would willingly accept to pay this amount and not pay the amount of price which he will invest in a more profitable activity. Suppose the rate of profit agreed in a Murabaha transaction of 6 months is 15% PA and the rate of profit declared to the depositors is 10% PA. It means that if the client withholds the price of Murabaha after its maturity date and keeps it for another 6 months, he will have to pay the compensation at the rate of 10% PA, which is much less than the rate of original Murabaha, i.e. 15%. As such, he will default and enjoy another facility for the next 6 months at a lesser rate. This proposal, therefore, is not only against Sharia, but also deficient in meeting the problem of default. The alternative suggestion. The question now arises as to how the banks and financial institutions may solve this problem. If nothing is charged from the defaulters, it may be a greater incentive for a dishonest person to default continuously. Here is the answer to this question. We have already mentioned that the real solution to this problem is to develop a system where the defaulters are duly punished by depriving them from enjoying a financial facility in future. However, as commented earlier, this may be only where the whole banking system is based on Islamic principles, or the Islamic banks are given due protection against defaulters. Therefore, a time when this goal is reached, we may need some other alternative. For this purpose, it was suggested that the client, when entering into a Murabaha transaction, should undertake that in case he defaults in payment at the due date, he will pay a specified amount to a charitable fund maintained by the bank. It must be ensured that no part of this amount shall form part of the income of the bank. However, the bank may establish a charitable fund for this purpose, and all amounts credited therein shall be exclusively used for purely charitable purpose approved by the Sharia. The bank may also advance interest-free loans to the needy persons from this charitable fund. This purpose is based on a ruling given by some Maliki jurists who say that if a debtor is asked to pay an additional amount in case of default, it is not allowed by Sharia, because it amounts to charging interest. However, in order to assure the creditor of prompt payment, the debtor may undertake to give some amount in charity in case of default. This is, in fact, a sort of yamin vow, which is self-imposed penalty to keep oneself away from default. Normally, such vows create a moral or religious obligation and are not enforceable through courts. However, some Maliki jurists allow can be made adjustable, and there is nothing in the Holy Quran or the Sunnah of the Holy Prophet Pbuh which forbids making this vow enforceable through the courts of law. Therefore, in cases of genuine need, this view can be acted upon. But, while implementing this proposal, the following points must be kept in mind. 1. The proposal is meant only to pressurize the debtors on paying their dues promptly and not to increase the income of the creditor financier, nor to compensate him for his opportunity cost. Therefore, it must be ensured that no part of the penalty forms part of the income of the bank in any case, nor can it be used to pay taxes or set off any liability of the financier. 2. Since the amount of penalty is not deserved by the financier as his income, but it goes to charity, it may be any amount willfully undertaken by the debtor. It can also be determined on percent per annum basis. Therefore, it may serve as a real deterrent against deliberate default, unlike the former suggestion of compensation which, as explained earlier, may tend to encourage the defaults. 3. Since the penalty undertaken by the client is originally a self-undertaken vow, and not the penalty charged by the financier, the agreement should reflect this concept. Therefore, the proper wording of the penalty clause would be on the following pattern. The client hereby undertakes that if he defaults in payment of any of his dues under this agreement, he shall pay to the charitable account fund maintained by the bank financier a sum calculated on the basis of percent per annum for each day of the default unless he establishes through the evidence satisfactory to the bank financier that his non-payment at the due date was caused due to poverty or some other factors beyond his control. 4. Give the stipulated amount to any charity of his own choice, but in order to ensure that he will pay, the charitable account or fund maintained by the financier bank is specified in the proposed undertaking. This specific undertaking does not violate any principle of the Sharia. However, it is necessary that the bank or the financial institution maintains a separate fund, or at least, a separate account for this purpose, and the amounts credited to that account must be spent in well-defined charities known to the client debtor. This proposal has now been implemented successfully in a large number of Islamic financial institutions. No rollover in Murabaha. Another rule which must be remembered and fully compiled with is that the Murabaha transaction cannot be rolled over for a further period. In an interest-based financing, if a customer of the bank cannot pay at the due date for any reason, he may request the bank to extend the facility for another term. If the bank agrees, the facility is rolled over on the terms and conditions mutually agreed at that point of time, whereby the newly agreed rate of interest is applied to the new term. It actually means that another loan of the same amount is re-advanced to the borrower. Some Islamic banks or financial institutions, who misunderstood the concept of Murabaha and took it as merely a mode of financing analogous to an interest-based loan, started using the concept of rollover to Murabaha also. If the client requests them to extend the maturity date of the Murabaha, they roll it over and extend the period of payment on an additional markup charged from the client, which practically means that another separate Murabaha is booked on the same commodity. This practice is totally against the well-settled principles of Sharia. It should be clearly understood that Murabaha is not a loan. It is the sale of a commodity the price of which is deferred to a specific date. Once the commodity is sold, its ownership is passed on to the client, not the seller. What the seller can legitimately claim is the agreed price, which has become a debt payable by a buyer. Therefore, there is no question of effecting another sale on the same commodity between the same parties. The rollover in Murabaha is nothing but interest pure and simple, because it is an agreement to charge an additional amount on the debt created by the Murabaha sale. Rebate on earlier payment. Sometimes the debtor wants to pay earlier than the specified date. In this case, he wants to earn a discount on the agreed deferred price. Is it permissible to allow him a rebate for his earlier payment? This question has been discussed by the classical jurists in detail. The issue is known in the Islamic legal literature as give the discount and receive soon. Some earlier jurists have held this arrangement as permissible, but the majority of the Muslim jurists, including the 4 recognized schools of Islamic jurisprudence, do not allow it, if the discount is held to be a condition for earlier payment. The view of those who allow this arrangement is based on a hadith in which Abdullah ibn Abbas is reported to have said that when the Jews belonging to the tribe of Banu Nadir were banished from Medina because of their conspiracies, some people came to the Holy Prophet alayhi as-salatu wasalam and said, "You have ordered them to be expelled, but some people owe them some debts which have not matured." Thereupon the Holy Prophet alayhi as-salatu wasalam said to them, i.e., the Jews who were the creditors, "Give discount and receive your debts soon." The majority of the Muslim jurists, however, do not accept this hadith as authentic. Even Imam al-Baihaqi, who has reported this hadith in his book, has expressly admitted that this is a weak narration. Even if the hadith is held to be authentic, the exile of Banu Nadir was in the 2nd year after Hijrah, when riba was not yet prohibited. Moreover, al-Waqidi has mentioned that Banu Nadir used to advance usurious loans. Therefore, the arrangement allowed by the Holy Prophet alayhi as-salatu wasalam was that the creditors forego the interest and the debtors pay the principal sooner. Al-Waqidi has narrated that Salambi Abu Hukayk, a Jew of Banu Nadir, had advanced 80 dinars to USAID ibn Hadir payable after 1 year with an addition of 40 dinars. Thus, USAID owed him 120 dinars after 1 year. After this arrangement, he paid the principal amount of 80 dinars and Salam withdrew from the rest. For these reasons, the majority of the jurists hold that if the earlier payment is conditioned with discount, it is not permissible. However, if this is not taken to be a condition for earlier payment, and the creditor gives a rebate voluntarily on his own, it is permissible. The same view is taken by the Islamic Fiqh Academy in its annual session. It means that in a Murabaha transaction effected by an Islamic bank or financial institution, no such rebate can be stipulated in the agreement, nor can the client claim it as his right. However, if the bank or a financial institution gives him a rebate on its own, it is not objectionable, especially where the client is a needy person. For example, if a poor farm has purchased a tractor or agricultural inputs on the basis of Murabaha, the bank should give him a voluntarily discount. Calculation of cost in Murabaha. It is already mentioned that the transaction of Murabaha contemplates the concept of cost plus sale, therefore, it can be effected only where the seller can ascertain the exact cost he has incurred in acquiring the commodity he wants to sell. If the exact cost cannot be ascertained, no Murabaha can be possible. In this case, the sale must be effected on the basis of musawama, i.e. sale without reference to cost. This principle leads to another rule: the Murabaha transaction should be based on the same currency in which the seller has purchased the commodity from the original supplier. If the seller has purchased it for Malaysian ringgit, the onward sale to the ultimate purchaser has occurred in US dollars, the price of Murabaha should be based on dollars as well, so that the exact cost may be ascertained. However, in the case of international trade, it may be difficult to base both purchases on the same currency. If the commodity intended to be sold to the customer is imported from a foreign country, while the ultimate purchaser is in Malaysia, the price of the original sale has to be paid in a foreign currency and the price of the second sale will be determined in Malaysian ringgit. This situation may be met with in two ways. Firstly, if the ultimate purchaser agrees and the laws of the country allow, the price of the second sale may also be determined in dollars. Secondly, if the seller has purchased the commodity by converting Malaysian ringgits into dollars, the exact amount of Malaysian ringgit paid by the seller to convert them into dollars can be taken as the cost price and the profit of Murabaha can be added thereon. In some cases, the bank purchases the commodity from abroad at a price payable after 3 months or in different installments, and sells the commodity to his client before he pays the full price to the supplier. Since he pays the price in dollars, its equivalent in MR are not known at the time when the commodity is sold to the client. Due to fluctuation in the price dollars and Malaysian ringgit, the bank may have to pay more than anticipated at the time of Murabaha sale. For example, the rate of US dollars at the time of Murabaha was 40 rupees for $1. The price of Murabaha was settled according to this rate, but when the bank paid the price to the supplier, the dollar rate increased to ringgit 41 for $1, meaning thereby that the cost of the bank increased by 2.5%. In order to meet this situation, some financial institutions put a condition in the Murabaha agreement that in case of such fluctuation in currency rates, the client shall bear the additional cost. According to the classical Muslim jurists, Murabaha based on this condition is not valid because it leads to uncertainty of the price at the time of sale. Such uncertainty continues up to a date after 3 months when the buyer actually pays the price to the supplier. Such uncertainty renders the transaction invalid. Therefore, there are following options open to the bank in this issue. 1. The bank should purchase the commodity on the basis of LC at site and should pay the price to the supplier before effecting sale with the customer. In this case, no question of fluctuation in currency rates will be involved. The Murabaha price can be determined on the basis of the market rate of dollars on the date when the bank has paid the price to the supplier. 2. The bank determines the Murabaha price in US dollars rather than in Malaysian ringgit, so that the deferred Murabaha price is paid by the customer in dollars. In this case, the bank will be entitled to receive dollars from the customer and the risk of the fluctuation in dollars price will be borne by the purchaser. 3. Instead of Murabaha, the deal may be on the basis of Murabaha sale without reference to the cost of the seller, and the price may be fixed as to cover the anticipated fluctuation in the currency rates. Subject matter of Murabaha. All commodities which may be subject matter of sale with profit can be subject matter of Murabaha, because it is a particular kind of sale. Therefore, the shares of a lawful company may be sold or purchased on Murabaha basis, because according to the Islamic principles, the shares of a company represent the holder's proportionate ownership in the assets of the company. If the assets of a company can be sold with profit, its shares can also be sold by way of Murabaha. But it goes without saying that the transaction must fulfill all the basic conditions, already discussed, for the validity of a Murabaha transaction. Therefore, the seller must first acquire the possession of the shares with all their rights and obligations, and then sell them to his client. A buyback arrangement or selling the shares without taking their possession is not allowed at all. Conversely, no Murabaha can be effected on things which cannot be subject matter of sale. For example, Murabaha is not possible in exchange of currencies, because it must be spontaneous or, if deferred, on the marginal rate prevalent on the date of transaction. Similarly, the commercial papers representing a debt receivable by the holder cannot be sold or purchased except at par value, and therefore no Murabaha can be effected in respect of such papers. Similarly, any paper entitling the holder to receive a specified amount of money from the issuer cannot be negotiated. The only way of its sale is to transfer it for its face value. Therefore, they cannot be sold on Murabaha basis. Reschedule of the payments in Murabaha. If the purchaser client in Murabaha financing is not able to pay according to the dates agreed upon in the Murabaha agreement, he sometimes requests the seller the bank for reschedule the installments. In conventional banks, the loans are normally rescheduled on the basis of additional interest. This is not possible in Murabaha payments. If the installments are rescheduled, no additional amount can be charged for reschedule. The amount of Murabaha price will remain the same in the same currency. Some Islamic banks propose to reschedule the Murabaha price in a hard currency different from the one in which the original sale took place. This was proposed to compensate the bank through appreciation of the value of the hard currency. Since this benefit was proposed to be drawn from reschedule, it is not permissible. Reschedule must always be on the basis of the same amount in the same currency. At the time of payment, however, the purchaser may pay with the consent of the seller, in a different currency on the basis of the exchange rate of that day, i.e. the day of payment, and not the rate of the date of transaction. Securitization of the Murabaha. Murabaha is a transaction which cannot be securitized for creating a negotiable instrument to be sold and purchased in the secondary market. The reason is obvious. If the purchaser client in a Murabaha transaction signs a paper to evidence his indebtedness towards the seller financier, the paper will represent a monetary debt receivable from him. In other words, it represents money payable by him. Therefore, the transfer of this paper to a third party will mean the transfer of money. It has already been explained that where money is exchanged for money in the same currency, the transfer may be at par value. It cannot be sold or purchased at a lower or higher price. Therefore, the paper representing a monetary obligation arising out of a Murabaha transaction cannot create a negotiable instrument. If the paper is transferred, it must be at par value. However, if there is a mixed portfolio consisting of a number of transactions like musharaka, leasing and Murabaha, then this portfolio may issue negotiable certificates subject to certain conditions more fully discussed in the chapter of Islamic funds. Some basic mistakes in Murabaha financing. After explaining the concept of Murabaha and its relevant issues, it will be pertinent to highlight some basic mistakes often committed by the financial institution in the practical implementation of the concept. First mistake. The first and the most glaring mistake is to assume that Murabaha is a universal instrument which can be used for every type of financing offered by conventional interest-based banks and NBFIs. Under this false assumption, some financial institutions are found using Murabaha for financing overhead expenses of a firm or company, like paying salaries of their staff, paying the bills of electricity, etc., and setting off their debts payable to other parties. This practice is totally unacceptable, because Murabaha can be used only where a commodity is intended to be purchased by the customer. If funds are required for some other purpose, Murabaha cannot work. In such cases, some other suitable modes of financing, like musharaka, leasing, etc., can be used according to the nature of the requirement. Second mistake. In some cases, the clients sign the Murabaha documents merely to obtain funds. They never intend to employ these funds to purchase a specific commodity. They just want funds for unspecified purpose, but to satisfy the requirement of the formal documents, they name a fictitiously commodity. After receiving the money, they use it for whatever purpose they wish. Obviously, this is a fictitious deal, and the Islamic financiers must be very careful about it. It is their duty to make sure that the client really intends to purchase a commodity which may be subject to Murabaha. This assurance must be obtained by the authorities sanctioning the facility to the customer. Then, all necessary steps must be taken to confirm that the transaction is genuine. For example, 1. Instead of giving funds to the customer, the purchase price should be paid directly to the supplier. 2. If it becomes necessary that the client is entrusted with funds to purchase the commodity on behalf of the financier, his purchase should be evidenced by invoices or similar other documents which he should present to the financier. 3. Where either one of the above two requirements is not possible to be fulfilled, the financing institution should arrange for physical inspection of the purchased commodities. Anyhow, the Islamic financial institutions are under an obligation to make sure that the Murabaha is a real and genuine transaction of actual sale and is not being misused to camouflage an interest-based loan. Third mistake. In some cases, sale of commodity to the client is effected before the commodity is acquired from the supplier. This mistake is invariably committed in transactions where all the documents of Murabaha are signed at one time without taking into account the various stages of the Murabaha. Some institutions have only one Murabaha agreement which is signed at the time of disbursement of money, or in some cases, at the time of approving the facility. This is totally against the basic principles of Murabaha. It has already been explained in this article that the Murabaha arrangement practiced by the banks is a package of different contracts which come into plat one after another at their respective stages. These stages have been fully highlighted earlier while discussing the concept of Murabaha financing. Without observing this basic feature of Murabaha financing, the whole transaction turns into an interest-bearing loan. Merely changing the nomenclature does not make it lawful in the eyes of Sharia. The representatives of the Sharia boards of the Islamic banks, when they check the transactions of the bank with regard to their compliance with Sharia, must make sure that all these stages have been really observed, and every transaction is effected at its due time. Fourth mistake. International commodity transactions are often resorted for liquidity management. Some Islamic banks feel that these transactions, being asset-based, can easily be entered into on Murabaha basis, and they enter the field ignoring the fact that the commodity operations as in vogue in the international markets do not conform to the principles of Sharia. In many cases, they are fictitious transactions where no delivery takes place. The parties end up paying differences. In some cases, there are real commodities but they are subject to forward sales or short sales which are not allowed in Sharia. Even if the transactions are restricted to spot sales, they should be formulated on the basis of Islamic principles of Murabaha by fulfilling all the necessary conditions already mentioned. In fact, if the client has already purchased a commodity, and he approaches the bank for funds, he either wants to set off his liability towards his supplier, or he wants to use the funds for some other purpose. In both cases, an Islamic bank cannot finance him on the basis of the Murabaha. Murabaha can be effected only on commodities not yet purchased by the client. Fifth mistake. It is observed in some financial institutions that they effect Murabaha on commodities already purchased by their clients from a third party. This is again a practice never warranted by the Sharia. Once the commodity is purchased by the client himself, it cannot be purchased again from the same supplier. If it is purchased by the bank from the client himself and is sold to him, it is a buyback technique which is not allowed in Sharia, especially in Murabaha. In this point we reach to the end of today's session. I hope that this video provided an informative and quick session. If you are interested in this area, kindly subscribe in the channel because we are planning to provide deep information as well as the latest reports and news about Islamic finance. We look forward to your subscribing, your like, as well as your suggestions in the comments. Have a good time and best regards.